Good morning, everyone in Business Law 2. I'm going to put up a brief video on Chapter 29 dealing with sole proprietorships and at least the structure of a partnership. How they're formed is actually the next chapter, which sometimes I think can bait you a little bit as you're reading through the chapter and saying, well, how do I actually form a partnership? What can I do to go through the process? But at least identifying some of the different kinds of partnerships are in this chapter, as well as an LLC. Um, but they'll be ferreted out in greater detail as we go through the other chapters. The videos I put up from YouTube, I think, are excellent. They help explain these business entities much better than I ever could. Those of you that have taken Business Law 1 with me, I actually cover these same chapters in that class simply because we broaden Business Law 1 to encapsulate what the different business organizations are. Um, we didn't just think it was critical at the Mount, or I didn't think so as a director of the legal studies program, to talk a little bit about business organization, business law 1, but it helped with the transfer compact we had with other institutions. So those of you that are in business law 2, and if you haven't covered anything in business organizations, it's great. It's I think a very digestible area. But those of you that took me for business law 1 or other business law 1 programs do incorporate the business organization outcomes or assessments in their core structure, it'll be a bit redundant. And if you took it with me, it's going to be absolutely redundant because we go through those same chapters. So no excuse on not doing well in the exam for this stuff. On chapter 29, it's going to start off with the different types of entities and why we choose them, whether there's great flexibility or there's loss of flexibility or there's complexity in management or the potential liabilities. And those are the main things we really structure our analysis around is, well, how difficult is it to create them? How difficult is it to run them? And what are the drawbacks, in terms of liability or lack of liability, which would make it an attractive business entity to choose? It starts off with sole proprietorships. Now, people often get, I don't want to say fooled, but duped. Well, duped and fooled are the same thing. But it implies simplicity because it is, but it also implies smallness or being a bit diminutive in terms of an overall business. You can have a sole proprietorship with thousands of employees with complicated managers that are hired. It just simply means all of the ownership and all of the final decision making rests in one person. That's the ease of it. Sole proprietorships pop up all the time. If you just decide today to start a business doing something, I don't say you go to law school, you pass the bar exam, you're a licensed attorney, and maybe it doesn't appeal to you necessarily to work for somebody else, and that's always been your dream to open up your own business. You can start off as what we call a sole proprietor or a solo practitioner because you're a lawyer. Same with doctors, do the same thing, right? Now, some people say, well, you have to be licensed. That's not necessarily true. You'd have to be a licensed attorney, you'd have to be a licensed doctor, but in order to start a sole proprietorship, you literally just have to start engaging in a effort to make profit in any kind of realm. Now, some people say, well, you have to get some kind of permit or something from the town. That's not always necessarily true. Sometimes if a town finds you are conducting a business within a community, they may require you to get some form of license, but that's sort of pro forma. It's just fundraising really for the town, and also a way to keep track potentially if there's some taxation issues on sales or something. But other than that, there's no usually real license requirement just to engage in business. You can start sole proprietor. It's the most common form of business because that's how oftentimes people don't even realize they're getting into business. They just start up and do it. I have, well, I guess my father's friends, kids, and I guess I hung around with them when I was a kid. They started a landscaping business back in the day as a sole proprietor, and it was kind of unintended. As a young person, he started mowing yards in the area. Then he got into learning a little bit about doing landscaping and plants and things like that. Next thing you know, he's got a few employees. Now, I think he's retired from it and sold it to somebody else. But it was big. He had like 40 trucks. He had all kinds of teams throughout Western Mass, and he was very successful. And he never changed his identity from a sole proprietorship. Well, why would you want to change your identity from a sole proprietorship? Because of the risk of loss. Sole proprietors are not only responsible for the day-to-day ownership of the entity, but they're also responsible for all of the risks inherent in the business. So if the business runs at a loss, the loss might be paid out of your personal assets that you might have been trying to keep completely independent from the business. So you invest a bunch of money. Let's just keep it in the landscaping realm. You invest $25,000 in a landscaping company, you get yourself a used truck, a trailer, a few mowers, and you start running the business. And for whatever reason, expenses start getting incurred. Maybe you have an employee, maybe you damage someone's property, and liability starts to come in. You're not only on the hook for the things that in theory are owned by the sole proprietorship, but because the sole proprietorship is you, you're responsible out of your own private assets that seem distinct from the company's purpose, but nonetheless it's at risk. And that's the big drawback of a sole proprietorship. And a lot of people, and I've worked with some people, I don't do a lot of business organizations now, but when I was practicing early on, sometimes people come to me because I want to organize a corporation or I want to organize a limited liability company. My first question, well, why? What's going on? And they say, well, I'm concerned that my employees or myself might cause torture, a negligent act or something like that, and I'd be liable for my own personal assets. I read it somewhere. I said, absolutely. But because of the lack of complexity in your business, and maybe the nature of the business doesn't really seem to have a lot of risk, a lot of potential for torts, another tool that you might want to consider, and I thought the chapter didn't even mention it, but I'm just thinking practically, is sometimes you can get a very, very robust liability insurance policy, not for debts, but for torts, negligence, intentional torts, things of that nature. And so if your concern is more about the tort aspects, what your employees or agents do, or you yourself do, and you want to preserve your personal assets, think about buying insurance. It might be a very cheap alternative. Why? Because we'll get into it in later chapters, but if you open up a corporation, it's not that difficult to do, but it's somewhat challenging to keep books, records, and go through processes and filings that sometimes people neglect. And as a result of neglecting that, they lose the protection of the liability that a corporation or an LLC can give. But that's for a later chapter. So sole proprietorships, very flexible management, ease in the organization. But what's the risk? Unlimited risk for your personal assets as well. But don't think it's just you. And I've had a few people say that in the end of the test questions, where they say, can a sole proprietorship have multiple managers, or I think there's something like that in the question, or employees that they can delegate authority to? And a lot of people say, no, they can't. No, yes, they can. The sole proprietor can have, I could be a sole proprietor and own a chain of stores. I'm obviously not going to run every single one on a daily basis. So I have employees that I would call managers, and those employees would also have agency powers. But the risk is what? The buck stops with me. And if they're doing anything within the realm and the scope of their authority and duties, even if unauthorized, I'll be liable for those losses as a sole proprietor. But again, the protection is not only in changing the business orientation to something other than a sole proprietor, it's also thinking about buying insurance. Now we talk about partnerships. So I've been a sole proprietor as an attorney, but I've also been in a partnership as an attorney. We'll get to it in the next chapter. But I want you to know that generally speaking, I think it's a good idea to have a formal partnership agreement, but you don't have to have one. It's just when two or more people engage in a business that doesn't have a limited project, meaning it's just going to be ongoing, that's a partnership. And you don't have to necessarily write up papers. You don't file them with anyone. And in the end, you can do a tax return based upon a partnership return, which is just really informational and purpose. The partnership, brought in $3 million, but there were 30 partners or something like that, and it was distributed such and such. Then we pay individual taxes on that income. The partnership wouldn't pay any. It's just an informational return. I'm not going to get too deep into it, but two or more people engage in a endeavor to make a profit. That's all a partnership is. Now, if it's for one project, that's not a partnership. A partnership should be kind of an ongoing purpose without limited duration. Now, there's limited duration in the law, meaning that if a partner dies or withdraws, the partnership is also dissolved. But other than that, the expectation is it wasn't just to do this one legal case. I have done this before. I've met with other attorneys that I hang around with their friends. There might be a big project coming up, and they say, hey, let's team up on this thing. Are we a partnership? No, but we do incur the same duties. We both have the ability to participate. We both share in profits. We don't have to share equally if we want to make a written agreement to otherwise. But otherwise, it's presumed we're going to share in profits and losses in a partnership in equal fashion, unless we write it up otherwise. We can write it up otherwise if we want. I'll tell you why in a minute. Really, in the next chapter, I'll tell you very well several reasons why. But it's for that one project, for one big case. that's called a joint venture. And so when people want, like all these terminology get out there when you're practicing or as a paralegal or attorney, just in life, maybe those terms have been a mystery to you. What's a joint enterprise or joint venture? Different than a partnership. It's one project or a series of projects and nothing more, where a partnership's an ongoing affair with unlimited duration, except for when we decide to dissolve it, or the government dissolves it for some reason, which is rare, or the parties, because of death or voluntary dissolution, partnership just kind of keeps on going. We're going to be a law practice, into the future with an unknown duration. But if we're just working on a one case, joint venture. Now, partners, given the ordinary or general partners, I was in a law firm where we basically had 4 attorneys. The 4 of us were general partners. General partners all have equal say in how the partnership will be run, but all 4 of us could bind the partnership and partnership decisions, and that's where the controversy comes up. So why do it? Well, unlike a sole proprietorship, all that responsibility is just on me to come up with the creative concepts and plans and figuring out the best tactic to run my business. But when you bring 4 people in, the reason why you bring 4 people in is, well, in some ways, I guess it is to feel better because you're kind of like a team, but it's also to bring in hopefully specialized skills. Like if I'm in the law firm, that's how it worked. I was actually mostly a litigation attorney. I like to go to court, but I felt somewhat more comfortable in court than I did doing state tax returns in the office or writing wills, and I hate doing family law stuff. And so we actually had 4 attorneys that kind of specialize in different areas. So that's one of the reasons why you might enter in a partnership. The pooling of abilities helps broaden our strength, right? So that's one of the reasons why there's a partnership. The other is the pooling of assets. I want to start a business and I've only got a few bucks, but if I get together with 2, 3, 10, 15 other people, and we all contribute our talents and our wealth or our treasure, sometimes they call it talents and treasures, and you incorporate them, it gives us power, it gives us strength, and it probably gives us much more likelihood of success. The rub or the challenge of it is, well, in the book it stresses, and I have to admit legally, what's the big challenge in a general partnership? I'm liable not only for anything the partnership loses, the partnership can be sued and the assets owned by the partnership can be lost to the lawsuit, but then they can go after me individually. And what if I'm the one partner that has a little bit of wealth and everybody else is basically on the verge of bankrupt? You can't get blood out of a stone. So can they sue me individually for the acts of the other partner? As long as it was in the course and scope of the partnership, they can. And that's the real risk of being in a general partnership. There is something called a limited liability partnership that takes special registry with the state. It's not that difficult to do. But if you're going to be a limited partner, the limited partnership has to identify you as a limited partner, and you can't do what? You're basically an investor. You can't participate in the day-to-day or regular decision-making and managerial processes of the organization. If you are, you lose the identity of a limited partner and you become a general partner. Even though you want to hold yourself out to the world as a limited partner, you've turned yourself into, by behavior, a general partner because it's reasonable for the public to believe so, and you've engaged in running the company. Limited partners are basically investors, and they have to basically also stay what we call sometimes silent. There's also something called a secret partner. Secret partner might be a general partner, but they're trying to avoid letting the public know they're involved in the entity. If they're discovered, they can be sued as a general partner. General partners participate in management decisions, and that's a slippery slope. But if I don't have, say I had $100,000 for some reason, and I heard it was a really good idea, 4 or 5 of my friends or colleagues are coming up with, and I want to invest in it, but I don't want to run the thing. So I said, okay, I'll throw in $100,000 and we'll have some kind of agreement that, I'll get 20% of all profits after overhead, annually after an accounting that we agree upon in some kind of accounting protocols. Some of you are probably business majors and want to go into accounting. There's all kinds of tools for that. It's way beyond my ability. But say, so I'm going to get 20% back on my on returns at the end of each either fiscal or tax year. And I just have to basically stay the hell away from it. I can be identified with it, but as long as I'm identified as a limited partner, I'm silent in the sense that I can't speak for the partnership and I can't do things like, hey, we should do this, we should do that, or we should refrain from doing this. Now I'm involved in the decision-making process. I waived my limited liability status. Very dangerous. Because think about it. I don't have $100,000, at least available liquid form. But what if I did? And to me, 100 grand would be a lot of money. Guess what I'm going to want to start doing right away? I hear what the gang's doing. I'm going to stop down with a cup of coffee. And what am I going to do? I said, come on, we're going in the wrong direction on this. We got to start going doing this other thing. We're going to advertise this way. I've converted myself from a limited partner to a general partner. Now I bear all the risk of loss. Very, very dangerous. So general partners, what's the beauty of it? The pooling of capital, the pooling of talents. What's I think part of the benefit of partnerships, especially general partnerships, the ease of organization. General partners don't have to create a partnership agreement, although I'm going to highly recommend it. I'll tell you why in a second. But you can just start it by 2 or more people entering into business. But what's the great risk? Individual liability beyond that which the partnership was engaged in. So the partnership loses 100 grand because of bad car accident or just a bad business venture it entered into. It bought a building and had toxic asbestos in it. We're required to remove it and cost us 100 grand. Well, the partnership only has $50,000 in assets that we dumped into it. Can they go after us individually? Yes. Again, going back to sole proprietorship, insurance is a nice protection for some things, for certain liabilities, but it's not going to protect you from losses. Just because the business is running poorly and you're spending more than you're having come in. The other liability that the book does talk about, I wish it talked about more, is the management. All general partners have the ability to make management decisions. So I used to joke in class when I taught like live, and this was actually one of my, not dreams, but I'm kind of all over the place thinking about as I get older. I thought it would go away, but it doesn't. I was thinking about different kinds of business, doing different kinds of things. And that was like 15 years ago. I actually thought about opening up a gas station, like a general store that had a small hardware store and a gas station. What the heck do I know about that? Nothing. I don't know. I just got excited about it. I get excited about goofy things that I have no skill or business being in, but I think about it sometimes. And one of the things I still think about, fantasize about, is owning like a gourmet coffee shop where we roast our own beans. We get the raw beans and we roast them on premises to create that aroma. And we specialize in really good quality coffees and also sell used books so I can seem like I'm an intellectual. Boheme quality type thing. So I can't do it alone. So I get 5 partners. Guess what happened? And so in my little fantasy story to give you a point of why it's dangerous to be a good partner, I come in one morning after being away for a couple of days, and all of a sudden I'm looking at the new flavors on the chalkboard. And one of them's bologna flavored coffee, and the other is what's that thing? My sister loves it. Curry flavored coffee. And I see the place is empty, and I'm like, what's up with these terrible flavors? One of my partners says, oh, I think this is the growing trend, meat-flavored coffees and spices that people like my sister like, but I certainly hate, and I think a lot of other people might not find it so fond in their coffee. Does that partner have the ability to do it? Yeah, if we don't have a partnership agreement that spells out who controls important decision makings, any individual partner can do management decisions, and that's a very big risk. So when I was in a partner, we didn't have initially a partnership agreement. And controversy, who do we usually partner with? Strangers? Well, sometimes I guess, but most of the time we partner with friends and family. That sounds great. Well, we're friends and family. We can work things out. We can be frank. We can be bold, and things will be fine because we all love each other and care about each other and stuff. But the reality is it just never works like that. So I was in a general partner, and things would come up, and we didn't have a lot of money. It was a law firm, and we had that one had 3 partners total. And just little things. We really had no money when we were first starting out. We're eager, pretty much right out of law school. I worked at another firm, but I left because I wanted to be getting into some political stuff, and I wanted more freedom. And so I just decided join these other people. And I thought it would be easy to get along and make decisions. But right away, there was issues about like, well, what do you need for a computer system? And I thought we should just all have individual laptops. We all practice in very different areas. But they wanted to have the other 2 partners wanted to have this big integrated system that cost a fortune. We had very few clients at the time. I thought it was a waste of money. But any one of them could have made that decision, and it would have bound me to have to pay, and it would have bound the other, but the other 2 would be out. So as things progress, other decisions that were a little strange, like how we were going to advertise. Back then, there's something called the yellow pages that were very, very significant for many attorneys to advertise. It was also very, very expensive. People are surprised how much it cost to put a quarter-page ad in the yellow pages back in the 1990s. And and then want to do a full page, half page, and I'm like, we're gonna go bankrupt or doing these things. So these arguments started to ensue. So we were in business maybe for 2 years, and then we decided to create a partnership agreement where we had management, and we had brought in another partner actually, and that partner, for lack of a better word, just had a really good sensible mind, and we all agreed that they would be the managing partner, and any one of us could make decisions to bind us into like a certain, for like under a certain amount of money. But for other amounts of money, the general partner would be bound to make the decision. And then we even made a higher one, like if we're going to buy real estate or if we're going to incur a debt over a certain amount, we had to have either a super majority, that would be 3 out of the 4 attorneys that were partners, or and then we said if the partnership were to grow, bring in new partners, we'd go to a super majority for certain decisions, and we had like ratios in there. So it really, really does help. If everyone's getting along, don't worry about it. But when there's problems, you refer back to that management decision process, and you have professional guidance on how to do things, because it's a real risk. I think about the last one. I still kind of partners with these people. We'll talk about presumptive partnerships later, where there's no formal partnership agreement, but maybe you're making decisions and trying to make income together. And even though you don't want to be partners, if the world believes you are, you might be held to that standards called estoppel. You're going to be denied the right to deny the existence of partners, sharing office space, you're doing different things. But I'm just thinking in 2002, just before I joined the full-time faculty at the Mount, I was in a partnership that was also a law office or a law firm, and we owned a building. And I was, there was no formal agreement, I was the one doing the day-to-day management for the building. Like if the oil was out, if the electric bills needed to be paid, if a window got broke and some glazing company had to come in and put a new window in or something, I always took all the responsibility for it. But I can remember I was literally at the Mount. We still owned the building. We were still a partnership. And the building ran out of oil. And I get a call from one of the lawyers at the law office saying, Jim, we're out of oil down here. And I said, well, the checkbook's right in that top drawer of my desk. And this other person was now in my office, but they had like 2 desks. And I said, just grab it. Call this such and such oil company that I use. We have an account, and we'll come right out and fill it up in the primate. And they said, well, can you call them? I don't have their number. And I'm like, you have their number. There are billboards like right outside of our office, but here's their number. Calling. What do I say to them? I want some oil. So this was a story I tell people many times about opening up a partnership. Sometimes some people end up doing a lot more work, but how do you share the profit? Equally, unless the partnership agreement says otherwise. But you have to have a written agreement that says otherwise. And why would we do that? Think about it. What if I am the one that's kind of the go-getter, the one that, or it's somebody named Bob. Bob's the real go-getter in the office, and he brings in a lot more work, and he does a lot more work. Maybe we should give him, say there's 4 partners. Maybe we should give him 30% of the returns. And then what about Jane? She really brings in the cash cows with the personal injury stuff. And boy, without her, our paychecks would be a lot smaller in the end. Let's give her 40%. And then the other 2 lawyers that don't make as much money, and maybe they're not nearly as dedicated because they don't want to put in the hours and things like that. Maybe they would get, I've already lost the math, what I gave the other 2, I don't know what's remaining, but whatever's remaining maybe be split to those other partners. You can have a hybrid agreement like that. And some firms do have really, I don't know, and sometimes even they have it spelled out in their partnership agreement what the different levels of partners are in terms of distribution of profits. I'm getting way ahead of myself. That's another chapter, but just want to think about that. So general partner, they're engaged in the regular decision making of the firm, but they also share all the liability. Silent partner, which is usually also a limited partner, they don't have any say in the business practices. And what do they get in exchange for that? They get to invest their money in it, and they get to get profits, but they don't suffer losses beyond their investment. Secret partner is usually a general partner, meaning they do have the ability to make decisions on behalf of the firm. They would share in the liability and profits of the corporation business, but they don't share in the liability if the victims or the ones that are owed the debt know of this secret partner's existence. And because you don't have to necessarily have a written agreement filed anywhere with the government, you may be able to escape liability because you're just unknown as a partner. Dormant partner, and you do have those sometimes. You might say, I worked at a firm, I'm getting old, and they want to keep my name on the letterhead. I don't really do that much work anymore, but maybe I had a reputation in the community. I don't, but say I did. And I'm not really active in the firm anymore. I'm spending all my time down at the Cape now, throwing sticks to my dog. It's actually kind of a dream of mine. And so I'm doing all these things, but my name's still on the letterhead. They call that a dormant partner. I'm not making really any decisions for the partnership anymore. I still could bear risk of loss, though, if there's damages to the partner. But chances are, if I'm a dormant partner, we probably have come up with some kind of written agreement as to me getting less of the profits as well, because it's only fundamentally fair. But that doesn't reduce my liability. And then a nominal partner. A nominal partner is one that's acting as if they are a partner, but they're not really a partner for the firm. The problem is they hold themselves out to third parties as a full partner, even though they're really not. They're going to risk liability potentially because they're going to be stopped, or they're going to be denied the ability to deny the existence of it because they've held them out as such, but they're not truly a partner. And I think that covers most of that, things related to partnerships. And again, disadvantages: unlimited personal liability, instability of the business when people die or quit, because that dissolves the whole partner. I have to kind of restart. You can do it all in the flash of the moment, but still, it's a pain in the butt. And then that's the big one, and I wish they expelled that out a little bit, but the divided authority among the partners. That could be real tough. And it depends on who's if you got somebody who's sort of the natural leader in the group, that might help a little bit. But let's face it, if you're out there and I think of another one. I have a friend of mine who's I tease her mercifully for what she calls it, cosmetologist or hairstylist or something like that. And she wants to open up she rents a space, I think, in somebody else's salon. I guess there's 5 things, and she gets to it's like a booth. It's not really a booth, but that's her chair, I guess, and those are her supplies. And she pays a fee to the owner of the building and to the salon that she works for. But she wants to open her own with 2 or 3 other friends, and she wants to do it as a partnership. And I told her, I says, what if somebody starts hanging up wacky signs out there or doing weird stuff? I mean, who's going to make decisions about that? Who's going to keep control? You might want to have a managing partner. And it should be dictated in writing, or a process by which decisions are made. Do you need a majority vote? You need be careful about unanimous decisions. If you guys are thinking about doing this, probably unanimous decisions, if the firm or the organization gets large enough, just like the Articles of Confederation, our first constitution in this country, if you need all 13 states to agree to something, it's never going to happen, no matter how wise an idea. And someone's always going to be an outlier and an objection. So you don't want to go too much beyond large majorities, like 75% or something. And usually most decisions should be majority decision or managing partner decision, unless revoked by a majority of the partners. Now, the other one, joint stock companies, I'm not even really talk about. That's very rare. It's basically a type of partnership where someone owns an interest by buying shares of it. It allows the partnership to continue on after death or retirement or dissolution of the partnership by one member leaving. Basically, it's continued in infinitum by the creation of stock, but it doesn't reduce your liability at all. So very rarely do people do joint stock companies. Joint ventures, where we talked about that, just for one project, you are free to engage in management decisions as a general member of the joint venture, but it's only for that 1 or 2 projects. It's an identified limited duration, and you have liability for that in your personal realm beyond that which is invested in the joint venture. Limited liability partnerships, those are LLPs. You'll sometimes see that in the business card. Limited liability partnership is basically must be registered with the state, and you have to file formal documentation to recognize you as a limited liability partner. It just basically everything else is run just like a partnership, but it limits the liability of those members of the limited liability partnership. Nice tool. They're all kind of dying out. I shouldn't say dying. They're losing some of their salience or popularity to something called the LLC. That's the thing that's really growing, and it is very easy to create. You can go online. I think it's $550, and you basically have to create articles of the business organization, like what's the business going to be for. It can be pretty broad or it can be narrow, and who are the members of the limited liability corporation. A lot of flexibility. Usually try to drop something very similar to a partnership agreement. Who's going to run it, who are the managers, and maybe there's going to be a board of directors. You can make it very complex like a corporation if you want, but it's not complex in terms of the filings that are required with the government. It's very simple. What the other huge advantage of it is the members of the limited liability company don't lose their personal assets. So if something happens with our limited liability company, and all of a sudden there's a $5 million judgment against us, and the limited liability company only owns $1 million. How are they going to collect another $4 million? Well, they're going to look to probably us individually, but what we'll be able to hold up as a shield, that state charter of a limited liability corporation will protect us from personal liability. The other huge advantage of it is after the end of the year, when we file our taxes, we can determine how we'll be taxed. Will we be taxed as a corporate entity? Will we be taxed as a partnership? Will we be taxed as a sole? There's all kinds of different methods. Whatever benefits us best, we can elect to do that with usually our tax expert will help us determine what will be best, but it can be decided after the fact, which is kind of nice. And there's a lot of flexibility in it. Members elect how the LLC be classified for income tax purposes, not just for one time, but every year they can kind of switch and swap if there's some kind of tax benefit. And the other is limited liability for the members. And again, those of you that are interested in doing it, you really don't need to turn into it. I don't know if they still sell those books. I have one somewhere. LLCs for Dummies or Limited Liability Partnerships, I think is in the same book. And it talks about the ins and outs of how to do it. I don't even think you need that. And you'll see the videos from YouTube. I think I posted about LLCs. Very, very easy organization to create. You do have to keep you have to keep books. You have to keep notes and things, because if you don't have a distinct entity for the LLC from the individuals that own it and run it, they may do something called piercing the veil of protection of the LLC. It's usually called piercing the corporate veil, but it means the same thing for LLCs. And so if you didn't keep the right books, you didn't file taxes based upon the LLC, and you're commingling your own personal funds with that of the LLC, you are basically a shell organization, and the government's not going to give you the protections of LLC because you're commingling funds, you're commingling assets. You're really just a mirror image of the LLC, but you're not holding yourself out as an LLC, and you're not keeping books distinct from it, and you're not keeping tax records distinct from it. They'll allow them to basically pierce that shield and go after you individually. Dissolution of an LLC. Well, one is if you don't pay you do your yearly filing and don't pay your fees, which are really de minimis, you'll be dissolved at some point. And the other is you can just give notice to the Secretary of State that you wish to dissolve. And why would you do that? You don't want people to be entering the contracts on behalf of the LLC if you no longer wish to exist. It's just a good way to clean up business. A lot of people don't do it. They just let it die in the vine, and you eventually lose the charter. It'll say, so if you look at the Secretary of State's office, sometimes you look up an LLC because you want to do a contract with it. You might say they are in some kind of either suspended status or they are dissolved. They say they exist at this period of time, but this is this dissolution date. Well, you don't want to contract with them because they don't have the power to contract. Many times when you do contract, this is a whole different topic, but many times when you do contract with a corporation or an LLC or a limited liability partnership, you might require that people, because you're worried about collecting, you might say, I'll agree to this, but I want you to have the right of personal liability to be brought against you. We want you as a suretyship or a guarantor on these contracts, or it won't go forward. And I had that happen to me. We actually had a corporation as a law firm that owned the building I was talking about earlier. And so when we went to buy, we were renting the building at the time, but then later we thought we had a great offer, and so we went to buy it, and we wanted to finance it through the bank. So I went to the bank, and they said, yeah, we'll give you the money but we want you to be individually to indemnify the corporation. If the corporation fails to pay the debt, well, it loses the whole purpose then for me. And so we didn't do it. We actually got it financed privately through family, which a lot of business, nothing wrong with that. I mean, sounds kind of almost wrong the way I said it, but if you have people who have money, they'll be glad to lend it to you at a good interest rate, and basically they lent the money to our corporation knowing full well, but they took a mortgage on the property too. So if we didn't pay, they could foreclose on the mortgage and therefore own the real estate, and the real estate was worth, I think, a great deal more at the time than the amount of loan we were taking. So, but the bank wouldn't do it. The bank said, we want you to promise to be indemnifiers and guarantees of this loan repayment. And it kind of defeated the whole purpose of our corporate identity at the time. Now, people say, well, as a corporation, do you have to share? No, most corporations that exist are existing for the purposes of pooling capital and to protect it from liability individually, but they're not traded publicly. They're called a closed corporation or a private corporation, and most businesses that are in a corporate status don't have that. They may have shares, but the shares aren't freely transferable or traded on a market. I went way too long in that chapter. It's a simple chapter. YouTube videos are way better than whatever I can do. in terms of these discussions, but I don't think it hurts to have some kind of connection. If you have any questions or concerns, please don't be afraid to email me, give me a call, shoot me a text. And otherwise, I hope everyone's doing well.